Hello, my name's David Miller. I'm the manager of Nexus Global Solutions Portfolio and the co-manager of Dynamic. I'm speaking to you from London. It's just after midday on the 5th of September. I give you the time and date because Brexit is changing by the minute at the moment, and it seemed appropriate to tell you when I was going on the record. This may not be a good time to go on the record about politics, but it certainly is still a good time to be on the record about investment because there's much going on and much to be done. So, where are we? Last month, August, was an indifferent month for investment. Solutions went down 1.3%, Dynamic down just over 3%. But year to date, the numbers are still exceptionally good. Substantial real returns. So Solutions is up 12.5%, 12.6%, Dynamic up over 16% year to date. As I said, these are real returns well over the rate of inflation, much better than cash on deposit. So why did markets have a setback? It was a combination of factors. The good news remains that economic growth is positive, company earnings are okay, better than expectations, even a bit, if slowing slightly from a year ago. Interest rates in the US came down. This is all good news, but against that there has been a steady erosion in confidence, and understandably so. The trade dispute between the US and China has good days and bad days, but on balance it's causing concern. The associated or local association with Hong Kong is obviously very disturbing, and riots on the street not good for confidence, let alone what's actually behind those. Then we have Brexit, which, as I said, is changing by the hour. Still no real clarity, but the key point from an investment point of view is that what happens in the UK and its trading relationship with Europe does matter. These are big economies, and we have to hope that sensible decisions are made. In the short term, this has caused confidence and uncertainty to go in opposite directions, and I think that's behind the market setback. So what have we been doing about it? Well, asset allocation for Solutions, about 45% in non-equity markets, 55% in equities. Dynamic is the equity portfolio, pretty fully invested at the moment. What we're doing is making changes at a stock-specific level. We're active investment managers, and that is what I'd like to talk about now, because I think that is the key to success for the remainder of this year and obviously into the longer term. So what's been working on at the stock selection level? We've actually been making money in certain of the investments against falling markets. The steady earners, on both sides of the Atlantic, have done a very good job for us. Companies like Coca-Cola and Visa, and the pharmaceutical companies like Pfizer and Merck, all of those in the US. In Europe, a similar pattern. Pernod Ricard, Roche, they're the companies that have really given us an uplift in value. And new investments in Dollar General, which is a discount store in the US, and Thermo Scientific, both of which we put into the portfolio, both making money for us right now. Now, Solutions is more diversified. Looking at the other areas, the 45% that isn't invested in equities, again, this has helped performance. That's why the downside was limited in August. Gold has been doing really well. Longer dated British government stocks have made good returns. Infrastructure, again on the right side of change, and the hedge funds that we're invested in. All of those have made us good returns in a falling equity market. And that's why we have that diversification, the emphasis on quality and liquidity. That's all really paying off in this environment. So that's really what's happened, where we are, what we've been doing about it. And I suppose the question is, what next? Well, the issue about trade between the US and China, if anything, it seems to be getting slightly better. That may be famous last words, but they're talking. Then we have the issue of Brexit, where the new Prime Minister and Cabinet the new government seems unable to force a no-deal hard exit at the end of October. But watch this space. But as that has become part of the public domain, interestingly, the pound has begun to strengthen. So markets are taking a view that a crash out at the end of October is less likely today than a week ago, and that's where we are. So we've also got interest rates cuts to look forward to, both in the US and in Europe. So a lot going on, a lot of uncertainty, as I said, but not an entirely bad environment against which to make investment decisions. So that's what we're occupying ourselves with at this time. That's where we are in early September, and I look forward to reporting more at the beginning of next month. Thank you.